Good morning and welcome to today's hub session, Excellegience hub session. We're really delighted that you could have joined us. We are going to be addressing the issue of financial statement analysis today, and in particular, we will be looking at KPIs that matter. My name is Jerry Blenman, and I am the Executive Director of the Caribbean Center for Organizational Excellence. We are going to go right into our session, and just a few things before we actually delve into the session this morning. We'll be looking at the defining context of financial statement analysis. This will capture our attention in the very first aspect of our conversation today. We will then turn our attention to the relationship between financial statement analysis and KPIs. And then we move on to looking at 14 KPIs that matter. And of course, we will have opportunity for any questions, discussions, etc. Now, do feel free as participants to raise any comments or questions during the session. We will primarily address these at the end of the session. Do remember as well, it is a lab. It is not a webinar per se. It is a lab. It's designed to empower individuals and businesses in the particular subject area, that being financial statement analysis and KPIs today. Now, what is financial statement analysis? And I guess that's the first question we need to address in our conversation today. What is financial statement analysis? And I wish to suggest that financial statement analysis is the process of examining a company's financial statements to assess its financial health, performance, and any potential risk that that entity may have. And this is crucial for decision-making by management, investors, creditors, and any other stakeholders, including employees, for that matter. So, just again, to reemphasize this, financial statements are not just a compilation of paper. Financial statements tell the story about how a company has been performing. Financial statements are important for understanding what went wrong and what is, what should be capitalized on because the entity is doing it well. Financial statement analysis is also quite great for historical review and analysis of a company. It's not just a compilation of paper. It is a process by which a company can be examined to determine its health. Now, in terms of the type of financial statements that comprise, or the documents, so to speak, that comprise financial statements, we have the income and profit and loss statement. And most people tend to pay attention to this one. This provides details of revenue, expenses, net profit or loss over a particular period. And there are a series of metrics that are derived from the income and profit and loss statement, namely the gross profit margin, operating profit, net income, earnings per share. We also have the balance sheet, which most financial institutions tend to also pay attention to because they want to look at the strengths of the company. And what this does really is provide a snapshot of the company's financial position at a given time. Do bear in mind that this is at a given time because the balance sheet changes day by day as sales occur, as varying things take place in the company. Assets are purchased, assets are written off or depreciated. The balance sheet changes. So it provides a snapshot of the company's financial position at a given point of time. And the key sections in the balance sheet include the assets and liabilities. So you could see all of what the company owes and also what the company owns. And you can also have a look at who are the shareholders and the makeup of their equity stake in the company. The metrics primarily used to assess the balance sheet include the current ratio, debt to equity ratio, and working capital. And we will look at some of these in a short while. The third statement that I would wish to share with us this morning is that of the cash flow statement. And this shows the inflows and outflows of cash from the operating, investing, and other financing activities in the operation. Notice I said that it shows the inflows and outflows not only from the operations, sales, but also from investments. So if the company has diversified its operations to include some investments in other companies or investment in government bonds or whatever, the cash flow statement captures the outflow of those funds, and it captures as well the inflows, dividends, etc., that may occur. And any financing activity that is generated by the company through a financing institution, a bank, credit union, or whatever, the cash flow statement shows the movement of that cash. And the key metrics typically are the operating cash flow and cash flow to debt ratio. Now, with respect to the actual analysis of the statements, you can do what we call horizontal analysis. And this compares financial data across different periods to identify trends in the operation. So a comparison of revenue from 2023 to 2024 would show the growth or decline in the operation. It may show trends with regards to one item having a much more impactful sales experience for the operation. It tells a story about what has been going on from a horizontal perspective. So it's what we call cross analysis data assessment. The second form of analysis that can take place with financial statements is that of vertical analysis. And this is where a comparison is done between one aspect of the balance sheet or financials or profit and loss statement and another area. So, for example, you could have a comparison between the total assets or sales, and we will see a ratio that speaks to that, I believe, when we look at the KPIs that matter. Or, for that matter, you can compare cost of goods sold as a percentage of revenue. So this is what is known as vertical analysis. And then, of course, we have ratio analysis, which will pretty much form the basis of our conversation this morning. And the ratio analysis is primarily used to do an evaluation of performance with respect to things like liquidity, solvency, profitability, how assets are being used, and if they're being used effectively, and a whole range of other ratios come into play there. Now, before we look at the performance, key performance indicators, I wish to just suggest to us that it's important to understand what a performance indicator is. And within the context of financial statement analysis, it is a measurable value used to evaluate and validate how efficiently a company is realizing its key business and functional objectives. And we did make a little mention of that a bit earlier, that it is used for the purpose of doing functional analysis and understanding what is happening in the operation. The matter of ratios speak to relationships. So when one is doing an assessment using ratios, you're actually looking at the relationship between one aspect of an operation to another aspect of it. And we talk about sales being a percentage of this, or staff being a percentage of this amount of revenue, the staff cost being a percentage of that revenue. So you're talking about a relationship of something in the organization to another thing in the organization. And I just find this really quite fascinating as a financial analyst myself, that you're able to just take a set of financial statements and tell, stories about what is happening in an organization. So it is a quantitative measure, and it is expressed in the form of a percentage or amounts or size or volume. And as I said earlier, it is an assessment between two or more things in the operation. Why is this necessary? To provide oversight and management to ensure business objectives and performance targets are being achieved as determined and scheduled. And this is very important for the purpose of verifying efficiency, determining that waste is not occurring in the organization. For decision making, if I have some ratios or some indicators that tells me that I did better than I had intended, then that's an opportunity to celebrate. If I see that I'm performing below margin, then that's a reason for concern and engaging in some review and decision making. The ratios are also very important for managing risk, for refining processes, for improving performance in the organization, for defining relations, for understanding the direction the company is heading. And we made mention earlier with respect to this whole matter of historical trend analysis. So performance indicators, key performance indicators are extremely important for the effective management of any kind of business or organization. They are extremely vital. And organizations that fail to pay attention to assessment, both vertical and horizontal assessment, as well as engaging in in-depth ratio analysis, could be missing the opportunity to make good decisions with regards to their operations. KPIs are predicated, I wish to suggest, on keeping good records. If good records are not kept, then you cannot produce good financial statements, and you cannot produce, KPIs that make sense to decision making and the direction that a company is going in. So KPIs are very important, and they are predicated on good record keeping. And this is an issue that we know with so many businesses, especially small businesses. But keep records, keep the records. We'll probably have another lab about how best to keep financial records. As well, KPIs are not written in stone, and that's important to note. A KPI is really a comparison of one thing to the other. And while within the context of the industry, we have been able to do a compilation of KPIs that makes sense and are relevant for assessing the organization, you can almost compare anything with anything using KPIs once it makes sense and is relevant to the operation. So in effect, the number of available KPIs are quite significant. They're not limited to those that we are going to look at shortly. They are quite significant. And I'll show you how I created one or two KPIs again to assist in properly understanding what is happening in an organization as we look at the KPIs that matter. So let's turn our attention now to 14 KPIs that I think are really important to the management, good management of an organization. 6 of them are going to be built around financial performance. 3 of them are within the area of sales, 2 human resources, 2 are on environmental analysis, and those 2 are 2 that I developed while doing an in-depth study, sustainable finance study, and then 1 on social well-being, and that too is one that I conceptualized again to help me with some analysis that I was doing and look at trends within an organization. So those within the context of financial measures. There's the net profit margin, which I believe most people are very much aware of. And the net profit margin, expressed as a percentage, looks at an organization's revenue and the amount of revenue, particularly that is available after all expenses and costs are met in an organization. So once all of the cost has been accounted for and all of the expenses are taken care of, what remains is the net profit margin. And very often this could also, be a net loss for an organization. Now, this is important for the purpose of defining opportunities for development and growth of the company. Companies grow when they are able to secure a net margin and reinvest that margin back into the development of the operation. It is also known as 0% financing for your operation. You would go to a bank or other financial institution and borrow at 10, 15%. If a company is able to generate enough profit, then it is positioned to create a 0% financing opportunity for growth in the operation. It is also important for measuring the operational efficiency of the organization. If an organization is operating efficiently, the likelihood is that it will generate a net margin. If it isn't, then that becomes a loss. And it is also an opportunity for determining any possible investment risk that may exist in the organization. And when we talk about investment risk as it relates to net profit margins, we are talking about whether or not you have got maybe assets that are not working well, not performing well to generate the required profit that the company should be generating. And they are taking up space, they are at a cost, and that could be very much an investment risk to the operation. So that's the net profit margin. And again, as you would see, it's not just the amount of money that is remaining at the end of expenses, but it's also a very important indicator for other elements of the operation of an organization. And then we have what is known as the asset utilization ratio. And I made a bit of mention to that a moment ago. And this looks at total revenue earned within an organization for every dollar of assets an organization owns. So if I own, let's say, $100,000 of assets, and those assets are turning over $250,000 for me, then my assets are really working well on my behalf. If it is only generating, $10,000, then the likelihood is that there is an issue. And I should say, you would have noticed earlier that the calculation for these is actually positioned at the bottom right-hand corner of your screen. So the asset utilization ratio is important for looking at how well the assets of an organization are generating revenue. It's also a determinant of how well management is actually putting the assets of the organization to use. So if I had to do an assessment of management of an organization, one of the first things I would want to do is see whether or not there are any idle assets in the operation. And of course, it's also an opportunity to improve management of what are known as non-performing assets in the organization. And the calculation is there, which is total revenue divided by total assets minus, which is equal to equal to the asset utilization ratio. The next one we look at is that of the revenue growth rate. And this is the change in an organization's revenue from one reporting period to a next reporting period. And this is important for determining the demand for a company's products or services. If a company's products and services are doing well, you should see an upward trend in the graph for revenue growth. If they're not doing well, then it's going downwards, obviously. And it's also an indicator of the need for probably, assessing whether or not the products are obsolete or becoming obsolete, whether or not, persons are competing aggressively with a new product. And it really tells quite a story with regards to what is being presented to the market and how the market is responding to what is being presented in an organization. And it's also a measure for how fast a company may be growing as well. When you see the revenue graph going northwards, then it means that the company is realizing some growth. And this is an excellent, really excellent ratio to keep an eye on, not only from an annual basis, but from a month-to-month basis. This is a really excellent ratio to pay attention to. The calculation is there as well. Now, the accounts receivable, this looks at the rate in the by days at which an organization is able to collect on outstanding accounts. So if an organization offers credit on its goods, you want to be able to collect that within a set period of time. Now, we also have another little ratio that's not here that says you should try to collect within at least 30 to 45 days. And the reason for that is because that represents the typical cycle, monthly cycle of any organization, where you have expenses coming in and you need the revenue coming in as well to match the expenses to ensure that the company remains viable and does not have a serious cash flow issue. So what the accounts receivable turnover does is help the organization to determine whether or not they will have cash flow issues. If people are not paying on outstanding credit, there will be a cash flow problem. There will be a cash flow problem. There will be a cash flow problem. And that often tends to lead the organization to using overdraft facilities, which becomes an expense to the organization. So it is important to make sure that attention is paid to getting those funds in if credit is offered within the set period of time. Where it's a financial institution, most institutions will say, look, pay your loan by the due date. And if you don't, then you probably will get a call within 7 to 10 days after that, because they want the cash coming back in so that they can continue to do further lending. It is also really a representation of any probable levels of litigation. Where people are not paying to time, the possibility is that litigation may have to take place, and that too is a cost to the organization. And an auditor would use this particular ratio and say you need to make a provision for bad debt, and you also need to make a provision for covering any cost of litigation. And more importantly, from my perspective as an analyst, is that it's an indicator of the quality of the credit policies being employed by the organization. So you want to pay attention to ensuring that the credit policy is adjusted to reflect the dynamics of the economic or socioeconomic situation at hand. Where prices are going up, then that really should drive institutions back to looking at their policies, their credit policy, and managing the organization to ensure that you don't have too much fallout. So again, you can see that the accounts receivable turnover has significant importance in the organization. So too does the inventory turnover, which looks at the number of times an organization is able to sell off its in-stock inventory in a given period of time. Now, this is important for the purpose of determining the level of efficiency and the timeliness of sales in the organization. You do not want to have goods sitting for more than 45, 60 days in an operation. And I say if it's sitting there for 45, 60 days, you need to be promoting it. You need to probably do a sale and get rid of it, because the longer it stays, the issue of it becoming damaged, depending on what it is, becomes, an issue as well. And loss can be incurred from that perspective. Of course, if there are perishable goods, you want to move them a lot faster than that, again, to avoid that high attrition rate. So the inventory turnover also is important for giving insights on how long cash is tied up in the production cycle. If it's a manufacturing entity, you purchase, raw material, and that raw material has to be processed to go to the point of sale, what we refer to as the SIPOC in lean management. And you want to be able to move that inventory, be it raw material or partially completed, to the completion state so that it can, realize cash in the operation. And we do look at that in a bit more in depth in some of our financial management programs. It is also an indication of overstocking and the ability to purchase raw material. If stock is not moving, and you need to purchase additional raw material or do a replenishment of goods, then you will have a problem. So the inventory turnover helps in that regard. The leverage ratio looks at debt to equity, and this measures how an organization is funding its growth and using shareholders' investments. So I put my money into the organization. I want to know that it is performing well so I can get a good dividend at the end of any particular period. Now, if the organization is taking funds from shareholders, but also borrowing very heavy from financial institutions, that's going to have an effect upon my shares. It means that my dividend is going to be a lot less than I would have anticipated. And so what management has a responsibility of doing is ensuring that the company is correctly leveraged. And that leverage, very often determines that no more than X amount in debt and no more than X amount in long-term debt, and no more than X in short-term credit relative to shareholders' funds. Yeah, and that's important. And who owns the company is normally who it is most indebted to. So if I'm a shareholder and the entity owes by far more money to the banking institutions, then it means that my shares really don't have that level of significance. And monitoring and managing this is important, both for shareholders and business owners, to ensure that they continue to keep control of their operations. So this is important for looking at the capital structure of the organization, its financial health. Any entity or individual that's over-indebted will experience poor financial health. And it's also an indicator of the ability to meet fixed financial obligations and address long-term solvency of the operation. And again, thirdly, an indicator of the financing strategy for the company. If you find that you're over leveraged, then it may mean taking some steps to reduce that leverage ratio in the operation. Now, here are some that speak to customer operations, and we talk about, and this one speaks to the average annual expenses to serve one customer. I wonder how many of us would have given thought to having that type of ratio in our operation. Now, this is the average amount needed to serve one customer. And yes, there is always an average cost for serving each customer. And if this can be managed effectively, it means that you do not have an overspend occurring with respect to one customer or the other. And it is important for controlling the cost relative to the customer base of the operation. It's also important for price setting on products and services and determining alternative selling channels. And this cost for selling can be quite inclusive in terms of operating costs, salaries, advertising costs, and a whole range of other things. And this is a really great ratio to determine, what really it costs to sell to one customer. And here's the thing. If it costs me $20 to sell to one customer and the profit I am generating is just $15, then the likelihood is that I am going to have an issue in my operation. And that's basically what this ratio is saying to us. The other one, and I love this one because this really is a determinant of the revenue that will be generated in an operation, is the customer retention ratio. And this looks at the number of retained customers to the number of at-risk customers. And at-risk customers here are those who are ready to leave and they will not come back to the organization because they have had a bad experience. And it's also an indicator of whether or not the company will be able to enjoy word of mouth marketing and whether or not they can depend upon that percentage of the customer wallet every single month, which creates a hardcore revenue opportunity for the operation. So this is a really beautiful one for helping to determine the viability of an operation. It's important for determining customer loyalty as well. It's also an indicator of projected marketing costs. If the ratio is going southward, falling off, then the organization may need to spend some more money on marketing and also spend some money on customer service and also spend some money on hearing from the customer in the form of some feedback mechanism if you really want this ratio to keep going northward. It's also an indicator of the quality of service or product being offered. If it is poor quality, and we made mention to this a bit earlier, then the likelihood is that the customer is going to leave the organization and go to a competitor. And again, you could see that this also speaks to this whole matter of the opportunity for growth in the organization because it serves as a sales and organization growth gauge. The third one here under customer is that of the average shopper value. And again, I know sometimes we don't pay attention to these things in operations, but this looks at the worth of every visitor to a store or to the office or to the website. If someone walks into an organization and they go back out without spending any money, then that represents really that's an indicator that should suggest something to the organization. Whenever traffic is occurring in the organization, there should be the expectancy that something positive in terms of revenue should take place. And what the average shopper value does is look at that over a period of time. We had 300 people walking into the store. And based on the 300 people walking into the store, we were able to generate X amount of opportunity or sales. And this gives us an idea of the number of shoppers in the store relative to sales. And again, this is a really beautiful ratio to consider. The two that speak to human capital that I think every HR manager, director, officer should always pay attention to is what is known as firstly, the human capital value added index. Most employees may not want to necessarily pay too much attention to this one, but certainly every HR manager should. And this looks at the average value an employee is adding to the organization. And just, by the way, every organization is set up with the idea that the human resource should bring more to the organization than the organization should give to it. That's how business operates. If it was not operating that way, then there would be an issue with respect to the continuance of operations, with respect to the strength of the business community, and by and large, the strength of opportunities for employment within any given jurisdiction. So that human capital value added ratio it's important for determining the profitability of the average worker in an organization. And yes, you can use the salary paid to someone and the value that they add to the organization to understand what contribution they are making to the organization. And this could be a little bit complex and questionable within some quarters, and it can be the cause for concern from time to time by the industrial relations, officials and such like. But the reality of it is this, that if there are people employed in an organization and they are not highly productive, they are taking more from the organization than the organization. They're taking more from the organization than they should be taking, and it becomes a greater cost to keep them in the organization, then a decision would have to be made, because every employee in an organization should really be bringing more to the organization than the organization is giving to them. And this is best seen especially in the area of sales companies. So a car salesman, he sells a vehicle for $150,000, but he just gets maybe a 10 or 15%. The rest goes to the company to replenish the stock, take care of expenses, etc. Right? This is also a really great determinant for the investment in human capital. And I have often said, if we measure the investment in a financial asset and we manage the investment in a hard asset, then we should manage the investment in human capital as well. The other one that really is, quite prevalent, especially within the hotel industry, is customers to staff ratio. And this looks at the staff optimization metric for managing and maintaining service levels. So if 20 people are in a checkout line in a retail entity and there's only one cashier, that becomes a problem. And that can affect the retention ratio. That can affect revenue because someone is likely to leave that particular item on the shelf and go. It can have quite a bearing on the organization. So it is really important for management or business owners to determine the number of customers that are typical to their operation and ensuring that staff are adequately available. In my banking career, one of the things that I did as a senior banker was I had a measure put in place, a little, a little laser thing put in place because I wanted to ensure whenever someone walked into the queue in the bank and they passed it, I wanted to measure how long it took them to get to a cashier. And what happened very often is that it will go from green to yellow to orange to red. Once I saw a lot of reds coming up on my screen, I would leave my desk and go downstairs to try to find out what was happening. Talk to customers, clients in the queue, and try to kind of quell the situation and make sure that, the customer has a good experience because this plays a vital role in terms of the relationship that the organization has over the long term. It's important. For creating really great service experiences. I say here, blow away service experiences. It is great for creating schedules that give effect to service quality and managing peak periods. If you know that Friday is going to be a big day, make sure that there are enough staff. If most people walk into the bank during their lunch hour, make sure that that's not a peak time for staff in the bank to take lunch as well. And it's also a great guide for determining areas of service for automation. I mean, I can go on that particular one for a while, but that's not the subject of our conversation this morning. And then the last three we look at, two on sustainability, and then the other one. And this is one that I thought very important while doing an assessment of an organization sometime back. The commitment to sustainability ratio 1. And there's also sustainability ratio 2. And this looks at the rate of contribution to sustainability. And, from my perspective, I saw this as important for managing corporate business environmental footprint and for also determining the level of corporate responsibility for attaining sustainable development goals. And so the ratio, as set up here, was established for this. And what it did at the time, because I was doing this sustainability study across the region, it helped me to be able to see, what the business community was doing with regards to environmental management and sustainability. And I was doing a cross analysis with banking institutions, financial institutions, sorry. So I was able to look at how financial institutions were also measuring it relative to the business community. The second one looks at demonstrating corporate responsibility for attaining sustainable development. So the first one speaks to where they're at. The second speaks to what they have been doing so that you can actually now report that I have been making a contribution to sustainability and this is my contribution. And so, of course, the calculation there sought to capture that. And the final one that we had paid attention to was that of the social development margin. And this was an interesting one because what I wanted to do with this was to understand whether or not entities were contributing to the social well-being of the communities that they were in and to what extent they were contributing to that social development, uplifting of the community. And you cannot set up a business in a community and not probably spend some money to sponsor a sporting club or a football group or something of the sort. So this was actually designed to capture this particular dynamic. And, it really helped in that regard. So it was looking at charitable donations and sponsorship revenue compared to net margins, etc. So these are the margins, and I'll share with you in a moment or so the resource sheet where you can actually get the manual on KPIs that matter. And that can probably be very useful. It has quite a number of them, more than the 14 here, probably 40 or so. And it also gives some further details with respect to how you can actually create ratios of your own. So let me just get that for you and put it into the chat. And if there are any questions, I'm also happy to answer any questions that you may have, any queries that you may have. Please feel free to post those, and I'm happy to answer those. Let me put this into the chat for you. It's a PDF, and in addition to the there it is. In addition to the manual, there's also a course that covers a lot more, that looks at OKRs as well as KPIs. And then there's also another resource which looks at mistakes in business. So you can click that. It will be only available here in the hub. So once you've clicked that and you've got that, then we can look at any questions. I don't see any questions. And when I don't see questions, I'm quite elated, because that means that we have covered the area quite well. And if there are no questions, then we will, in a moment or so, bring the lab to a close. What I would say, while I wait to see if there are any possible questions, is that, financial statement analysis is probably the biggest aspect of any operation if you're a small business operator. Do not ignore it. Get the manual, and do not ignore the importance of running, or having a set of ratios where you just put in the numbers on a weekly, monthly basis to see how your operation is performing. That's, to my mind, of extreme importance to the good management of any organization. So I'm going to close out the session by asking a quick question, and you can probably just put yes for this. Was this helpful? Did it help? And was it clear? And if it helped, just please say yes. Are the notes being shared for this session? Yes, I will make the notes available, but because it is a lab, I would want to encourage you not to share it widely. It will just be shared to those of you who are a part of the lab, because we repeat our labs from time to time with different groups. Yes, so I'm seeing definitely yes, helpful. There are quite a number of you on here, so I know there are quite a number of you who can also respond. Please let us know so that we can also improve on this if we have to improve on it for any future labs and clinics. Yes, very helpful. Thank you very much. Yes, it was very helpful. Thank you. Thank you. Good day. Which accounting standards are used there? I'm based in South Africa, and we use IFRS and IAS. Well, I was not particularly using any particular standard for that matter. We were just broadly looking at ratios from a general perspective. But I do understand the question you've raised, because different accounting standards require that things are measured in different ways. And that's why I said earlier that, the whole matter of ratio analysis is quite dynamic, and you can pretty much adjust them to reflect what is required either from from a corporate responsibility perspective or from a regulatory perspective. Yes, thank you so very much, those of you who have responded. And we are happy that it was helpful. We will send out the recording. And as said earlier, please do keep it to yourself. We will also attach the source sheet so that those of you who want to tap into any of the resources can do so. Thank you so very much. My name is Jerry Blenman, Executive Director of the Caribbean Center for Organizational Excellence. Have yourselves a fabulous